What if a quiet £543 million deal just marked another turning point for London's financial market? A US firm has agreed to buy a long-standing UK-listed finance company, ending nearly 2 decades of its life on the London Stock Exchange. At first glance, it looks like just another takeover. But beneath the surface, it reveals how global money is shifting, why British markets are losing ground, and how financial power is quietly moving across borders. This story is not just about who bought whom. It is about what the UK is slowly losing, and what the rest of the world is gaining. The deal centers on international personal finance, known as IPF. For almost 20 years, IPF traded as a London-listed firm. Now that chapter is closing. The company has agreed to a £543 million takeover by New York-based BasePoint Capital. The offer values IPF at 235p per share, paid entirely in cash. That represents a 31% premium compared to the share price before talks became public. On paper, shareholders are being rewarded. In reality, something bigger is happening. IPF confirmed discussions with BasePoint at the end of July, after months of quiet negotiation. Both sides understood the decision would reshape the company's future. By the time the board recommended the deal, it had accepted a difficult truth. Remaining listed in London was no longer delivering the value the business expected. This is where the story turns darker. IPF is not a household name in the UK, but its reach is wide. The company provides small consumer loans across 9 countries in Europe and Mexico. It serves around 1.7 million customers, many excluded from mainstream banking. These are underbanked individuals who rely on alternative credit. Yet, despite being listed in London and headquartered in Leeds, IPF has no customers in the UK. That detail matters. IPF began in 1997 as part of Provident Financial. In 2007, it was demerged and listed separately on the London Stock Exchange. Since then, it operated internationally while relying on London's capital markets. Over time, that relationship weakened. The company consistently traded at a discount to comparable international lenders. For more than a decade, its market value failed to reflect what the board believed it was worth. That gap never closed. Eventually, the pressure became impossible to ignore. Chairman Stuart Sinclair made the reasoning clear. The board still believed in the company's long-term strategy. But belief does not always translate into market confidence. The takeover offered shareholders what London could not: immediate cash at a price the board considered fair. The real question is not why shareholders accepted, it is why London could not keep them. BasePoint Capital saw the opportunity clearly. The US firm has deep experience in consumer specialty finance and had followed IPF for years. Its leadership described IPF as a strong platform with international reach and a focus on financial inclusion. From BasePoint's view, this was not a distressed asset. It was an undervalued one. That is where this deal becomes a market signal. Cross-border consolidation in finance is accelerating. US firms are increasingly buying established international businesses rather than building from scratch. Europe offers scale, regulation, and existing customer bases. For UK-listed firms with global operations, overseas buyers are often willing to pay more. That imbalance is growing. BasePoint is not just acquiring a loan book, it is acquiring systems, data, and infrastructure built over decades. And it is doing so while London struggles to retain listed companies. IPF joins a growing list of firms leaving the London market or being taken over by foreign buyers. Each deal alone seems manageable. Together, they form a pattern. Capital is flowing out, and control is shifting elsewhere. The process is calm. No crisis, no emergency, just approvals and a clean cash offer. That calmness is what makes it dangerous. Quiet takeovers reshape systems without resistance. Employees are reassured. Customers are told nothing will change. Regulators focus on stability, not symbolism. But symbolism matters. IPF represents something London once did well: hosting global finance firms, acting as a capital hub for international businesses, offering credibility and long-term visibility. When firms decide London no longer adds enough value, the loss compounds over time. BasePoint plans to expand IPF with deeper capital and US-based expertise. From a business view, the logic is clear. IPF gains resources. Customers may benefit. Shareholders receive cash. But London loses influence. And influence rarely returns once lost. Decisions about risk, pricing, and expansion will now be made from New York, not Leeds. The center of gravity has shifted. This raises an uncomfortable question. If London cannot properly value firms like IPF, how many others are preparing exits? Markets do not collapse overnight. They hollow out deal by deal. The IPF board framed the takeover as unlocking value the public market failed to recognize. That is rational. But repeated rational exits lead to structural decline. Fewer listings reduce liquidity. Lower liquidity weakens valuations. The cycle feeds itself. This deal fits perfectly into that loop. For BasePoint, the timing is ideal. Consumer finance remains profitable when scale reduces costs. By acquiring IPF, BasePoint avoids years of regulatory setup and brand building. For shareholders, a long period of undervaluation ends in one transaction. For London, the loss is harder to measure. It is not about IPF alone. It is about confidence. Once confidence erodes, listings follow. That is why this takeover matters beyond the headline number. £543 million is not the largest deal in finance, but its signal is larger than its size. The UK remains stable and respected, but it is no longer always the best place to stay listed. That message spreads quickly. IPF may grow under BasePoint, customers may benefit. Inclusion goals may advance. But value creation will now be anchored elsewhere, not in London. And as more firms reach the same conclusion, the shift becomes harder to reverse. This deal answers a quiet but unsettling question. What happens when global finance decides London is no longer essential? The answer is not collapse. It is silent migration. One company at a time. One premium offer at a time. One reasonable recommendation after another. By the time the pattern is obvious, control has already moved. If this breakdown helped make sense of how global finance is really shifting, support the channel by liking the video so more people see it. Subscribe for clear, grounded stories about money, markets, and power that rarely get explained properly. And share this with anyone who still believes financial influence only changes during crisis.